Hey everyone, welcome back to Corporate Decoder. Today we're digging into Goldman Sachs' latest shareholder report, but don't worry, I promise not to bore you with banking jargon or endless spreadsheets. I'll be focusing on two funds, Goldman Sachs Income Builder Fund and Goldman Sachs Rising Dividend Growth Fund. It's like watching a high-stakes poker game, but instead of cards, we are analysing numbers to see what Goldman Sachs is betting on. If you're new here, Corporate Decoder is a place where we dissect complex corporate publications in an engaging and clear fashion. Also, if you appreciate getting straight insights from corporate documents, make sure you check out the Discord server linked in the description below too. This report covers the 6 months from November 1, 2024 to April 30, 2025 and has financial data that has some clear stories to tell. Let's start with the Goldman Sachs Income Builder Fund. The most relevant numbers are the cost for a $10,000 investment. For Class A shares, that's $39. Let's dissect where the Income Builder Fund is placing its bets. A significant chunk, 6.9%, is in financials, with healthcare following at 5.2%. Banks get a comparable share with 5.1%, with consumer staples, industrials, pipelines, and utilities follow closely. The document calls the other allocations just other, with a combined percent of 57.6%. Some key stats to consider: total net assets in the fund are huge, sitting at around $246 billion. The fund juggles 828 different portfolio holdings and has a portfolio turnover rate of 16%. Put in simple terms, it holds a lot and doesn't change its investments much. The report proceeds to make the same report again to highlight the values of Class C shares. This time it cost shareholders using Class C shares $76 for every $10,000. The other key details are the same again. Now we see the values of Class P shares. To get through it quickly, here are the main points. These cost $22 and all the key data remains exactly as before. Class R6 shares also show us the costs and the values are the same as the Class P shares. The institutional shares also cost $22 and values all remain the same. Lastly, the investor class of shares cost $26. That wraps up the first fund. In short, all but the share data is basically the same through the different fund types being offered. We can, however, identify the cost to shareholders across share types to see just how they are all different. Now on to the Goldman Sachs Rising Dividend Growth Fund. Prepare for another roller coaster of numbers as we look at the different details of growth holdings for this fund versus the income-focused fund we just looked at. Starting directly in the numbers, Class A shares cost an investment of $49 for every $1,000. Now, this is different. Here we can more energy and tech. There's still holdings in financials, healthcare, and consumer discretionary, but all the other allocations are significantly lower than before. And with information technology making up 26.8% and energy making up 14.1%. Total net assets are understandably lower too, sitting only at $41.49 million 17. The portfolio turnover in 17. The portfolio turnover rate is surprisingly negligibly higher, however, at 22%. Class C shares cost a sizable $85 and shares everything else previously shown. Class P shares cost only $33 and shares everything else previously shown. Class R shares cost an average of $61 and shares everything else previously shown. Class R6 shares only $33 and shares everything else previously shown. The institutional shares cost $33, all else the same. The investor shares cost $37, all else the same seeing all the different reports repeated, highlighting very slight differences between the various funds, allows us to see just how much Goldman Sachs has diversified their own offerings in both high growth versus more consistent income shares. It also lays out some clear differences for investors into which share types they should be using depending on how much they plan on investing into the company itself. Moving on, let's look at the less numbery sections. They state they've adopted a code of ethics for their top folks to follow. Nothing changed in it, and no one got any special passes around it as well. Next up, they confirm Michael Latham checks out as the audit committee financial expert that meets the standards of being both qualified and independent. The form just points to the financial statements we just talked about, so let's skip it. More to the specifics of the report, it looks like what we should care about is already covered in the previous documents. Schedules of investments, statements of assets and liabilities, statements of operations, and notes to the financial statements. So we don't need to spend any more time than we just had to. Now let's find ourselves actually in the financial statements. This is going to get technical, so I'm going to try to keep it simple. A key indicator is the sheer amount of different bonds they have taken with various firms in different industries. For example, with the Goldman Sachs Income Builder Fund, we see everything from ABSA Group Ltd, a Southern African-based financial services groups, and the sheer percent of bonds, notes, and agreements that they secure. Then here we see a European one in the form of Banca Transilvania SA. The fund appears to have a very diverse portfolio geographically too. The fund appears to have many of these similar agreements to get steady, secure results in the portfolio. Many more companies appear and almost all are related to agreements with banks. Here and repeated across the schedule, this just means that it's a necessary part of understanding the financial statements. Now digging into the apparel section, we can see they are also using debt securities on risky assets too. By investing in companies such as Champ Acquisition Corp, even more risky because this corp deals in fashion. This is also spread to automobiles with Hyundai Capital America, and looking at the energy sector, everyone is energy debt securities agreements to make stable and good returns. There's not much out of the ordinary here or numbers that pop out other than that they are extremely financially diversified with many different corporations. Now, as for the second fund, we can expect to see very similar numbers. Perhaps one area to scroll to specifically is what a good investment to make the most amount of money is. Alright, let's zoom out. After the financial details, the form shifts, covering routine protocols such as the code of ethics. Nothing to see here. Now that we've gone through a lot of this, let's look at a summary analysis of what it all means so we can try and put all this into a brief summary that gets to the core of the content as quickly as possible. GSM appears to be heavily focused on stable, long-term strategies, emphasizing low turnover and diverse financial instruments to provide slow and stable returns. They are doing nothing fancy and prefer to keep a large pool of stable investments instead. A notable risk seems to be the substantial use of complex debt securities that, while proven, are a little more concerning during periods of high inflationary pressures, given that these are all long-term obligations. This could get more difficult for them depending on changes on how those rates are managed. In closing, I am seeing nothing that appears to be cause for concern, but many of the more interesting high yield gains also are inherently higher risk. So it may be best to look at other smaller individual funds instead. This shareholder report confirms a stable, if not spectacular, direction for Goldman Sachs' dividend-focused funds. What are your thoughts on this financial filing for Goldman Sachs? Do these details change your level of trust in them, or are they irrelevant compared to individual actions? Also check the Discord link for engaging with our community. Thanks for watching.